Good afternoon, or depending on your time zone, good morning. My name is Dennis Cook, and I will be producing today's webinar. Let's go ahead and get started. On behalf of Reunion, I'd like to thank you for joining us today. This is our inaugural seller office hours. We'll hold these sessions once a quarter to equip you, our developer partners, with our latest market insights, as well as answer whatever questions you may have. And I hope questions is the theme today. I'm joined by Reunion's co-founders, Andy Moon and Billy Lee. They'll be hosting today's session. And before I hand it over to Andy, I'd like to quickly run through some house cleaning items. First and foremost, we are recording today's session. We want to make sure folks who are unable to join live can view the webinar as well as view a transcript after the fact. If you are uncomfortable being recorded, we'd respectfully request that you please exit the webinar now, and stay tuned for the recording. We have disabled audio and chat to minimize background noise. With that said, we'd still ask for you to put yourself on mute throughout the webinar just to play it safe. Third, questions are welcome. At the bottom of your screen, you should see a Q&A button. Please ask questions in real time using that functionality. Billy, Andy, and I will see it. We may not answer questions immediately, but we've set aside the latter half of this session to answer any and all questions. You can do so anonymously. There is a checkbox to ask questions anonymously, but you don't have to. We also recommend using gallery mode. In the top right corner of your screen, you should see a view button. Gallery mode will keep you from getting seasick when Zoom takes it upon itself to jump back and forth to whether Andy or Billy is speaking. Finally, if you have connectivity issues or accessibility issues, please email me and we'll troubleshoot behind the scenes. My email is Dennis with one N, DENIS @reunioninfra.com. Thank you again for joining us, and thank you for everything you do to accelerate clean energy. And with that, I'll hand it over to Andy to preview today's agenda.
Thanks so much, Dennis. And thank you all for joining our first seller office hours. We're very excited to be having this conversation with you today. Since Reunion was founded in late 2022, Billy and I personally have had multiple hundreds of conversations with clean energy developers and manufacturers looking to sell their clean energy tax credits. And so we're excited to have this format where we can sort of reach more people and answer questions in real time, and also share with you the latest market insights based on how quickly this market is moving. Our aim today is to have this conversation be as interactive as possible. And so we will go over through a bit of a set agenda, hitting up pricing and market trends, key negotiation points that we're seeing from our experience working through real deals. And then one question that's come up a lot is ITC and PTC due diligence considerations. We'd like to equip sellers with as much information as they can have to prepare for diligence once they go into an active transaction. We will leave plenty of time for Q&A at the end. So as Dennis mentioned, please feel free to put your questions in the chat. We'll kick it off with a very quick introduction. Billy and I met back in 2008 at one of the leading solar development companies, and we were involved in many of first-of-its-kind financing, so some of the first tax equity and private equity transactions in the solar industry. We have been in your shoes before as financiers and as developers of solar energy and clean energy projects, and so we do understand the challenges in lining up financing for your projects and are super excited to be working with all of you in this exciting new world of transferring tax credits, which has proven to be a much more straightforward process than the traditional way of doing tax equity. I'll hand it over to Billy for his introduction as well.
Thanks, Andy. Yeah, as many of you know, Andy and I go way back. I've spent my entire career, ever since graduating from business school, in renewable energy finance. I was one of the first employees at SunEdison and have thought about tax credits and financing pretty much every day since then. And, you know, I was very lucky to get into the renewable energy world shortly after the Energy Policy Act of 2005 created a 30% ITC that we've come to be accustomed to. And that was kind of a once in a generation kind of change in regulations and legislation that that allowed for the early growth of the industry. And transferability to me is kind of another once in a generation opportunity. So we're really excited to be here and talk about tax credit transfers and really help everyone in the industry progress further.
Thanks, Billy. So I'm sure most of you are familiar with Reunion and what we do, but very briefly, we work closely with clean energy developers and manufacturers to sell tax credits. We were the first to launch a digital marketplace, which now has a very large supply of credits available for purchase. I think the reasons why developers work with us is because we've been developers ourselves and we've been in your shoes, and so we do understand that speed, price, and certainty of close are top of mind for tax credit sellers. In terms of speed, we work with a very deep pool of vetted tax and treasury groups that are looking to purchase these tax credits. And we work closely to understand what they need to see in terms of due diligence and help ensure that sellers are able to provide due diligence materials in an organized and standardized format. In terms of getting the best price, making sure that your project gets seen by the widest audience is of core importance. And our aim as a marketplace is really to streamline the process using technology and repeatable processes. And so the idea is to make the transaction cost as thin as possible for you, so that's more money in the developer pocket. And finally, certainty of close is something that we know is core from the developer standpoint. So really ensuring that there aren't huge surprises in the process. And so we really, given we've been through so many of these clean energy financings in the past, we try to make sure that sellers are well aware of what's coming down the pike, and that any sort of diligence or other requirements that will be required by the buyer are made very, very clear up front. So shifting to a bit of the market dynamic, our estimate is that in 2023, about $5 to $7 billion of tax credits were transferred, which is incredible if you think about the fact that the IRS only issued guidance in mid-June. Tax credit supply was constrained in 2023. And I think that's created an interesting dynamic for 2023 tax credits. What we saw happen was after the regs were released, buyers took a quarter or so to get sort of familiarized with the program. And by Q1 2024, there's just been an incredible amount of demand from buyers looking for 2023 tax year projects. The paradox is by that time, there have not been that many 2023 credits available. We are, in fact, still working through some last minute 2023 transfers. And I'd say pricing is relatively high on these transfers due to the very limited supply. If there's developers that are still looking to transfer 2023 credits, we are more than happy to work with you, because there are quite a few buyers that are still looking to offset 2023 liabilities. The change in 2024 is activity has ramped up significantly. We are seeing transactions of all sizes. So we are seeing transactions, even $1 million or even slightly below that. And we're currently working on transactions from $150 million to even north of $1 billion with a single seller. I'll quickly go through some indicative pricing. These are based on real data that we've seen both through our marketplace as well as through publicly announced transactions. But the transactions typically fall in a few different buckets. So current year production tax credits are trading at the lowest discount. And these prices reflect sort of pricing that the seller would receive. It does not include the cost of insurance. So if the buyer requires insurance, then that cost typically would come out of the net proceeds that ultimately go to the seller. For current year PTCs, these are trading sort of in the low to mid 90s per dollar of credit. And I think in general, the larger the transaction, the smaller the discount tends to be. Everybody's familiar with the $700 million 45X transfer that happened sort of at the end of 2023. And that was trading sort of closer to mid 90s. De-risked ITCs tend to be at least $10 to $15 million in transaction volume. These are from proven technologies such as wind, solar, battery storage. these are typically trading in the low 90s per dollar of credit. And more complex ITCs, so transactions that are smaller or that are from technologies that have less robust buyer demand, such as biogas, tend to trade at a wider discount.
Hey, Andy, we do have a question here. If you could go back to the last slide. What about 45X? Are those considered PTCs? I would say that we do distinguish PTCs from 45X AMPCs. So typically when we talk PTCs, we're talking about the Section 45 PTC. I would say that there's a couple distinguishing characteristics between AMPCs and PTCs. One, I think in general, PTCs, it's harder to get scale because remember, these are 10-year PTCs. So we are doing some portfolios of PTCs, but single asset PTCs, even if they're several hundred megawatts, it's tough to get huge volumes, whereas we're seeing very, very large volume 45X transactions. In terms of pricing, I think correct me if I'm wrong, Andy, if you think differently, but in general, if 45X is trading very close to PTCs, I think from a perceived risk standpoint, which is not really exactly real risk, but from a perceived risk, I think operating projects with PTCs are kind of the gold standard of easiest and lowest risk, but 45X are up there.
Yeah, I think that's right. And I think that, PTCs trade in maybe a slightly wider band versus the operating PTCs. But I think that $700 million 45X transaction gave a lot of buyers the idea and the interest in these types of transactions. I think the similarities with the AMPCs are that, they are not generally subject to recapture risk, and they typically can be structured to be purchased quarterly in arrears. We'll get into this a little bit more in the conversation, but the timing of the payment from the buyers is of paramount importance, and so a lot of buyers are attracted by a quarterly in arrears payment structure where they can commit to, call it $100 million of credits up front, and immediately be able to offset their quarterly estimated tax payments. So both PTCs and 45X credits carry that ability to structure the payments in that way.
Good point.
A few other market trends we'd like to highlight for you all. So one is, as mentioned, pricing or project size is a major driver of pricing. So aside from the parameters we just discussed that drive pricing, we do generally see a relatively wider discount for very small projects. After all, the buyer does need to get an absolute dollar amount of tax savings for the amount of sort of trouble they're taking to purchase the credit. And on the flip side, for very large projects in the multi-$100 million and up, we are seeing those generally trade at a smaller discount. Insurance tends to have some minimum premium amounts, and as a result, insurance does get relatively expensive for projects that are in the low single-digit millions. We do think that this is an area of innovation. We see a lot of opportunity to sort of figure out ways to creatively mitigate risk for smaller projects. And this is, of course, one of the goals of transferability, to enable smaller projects and smaller developers as well to more easily monetize their tax credits. Ever since we saw the energy community guidance in March, there has been an uptick as well in projects that are claiming that extra 10% bonus adder for energy community. And finally, one very important trend that we'll get into here is that for many buyers, the timing of the payment is very important. And I'll flip to the next slide to talk about this. This goes in quite a bit of detail, but I think it's important for sellers to understand this. So in general, if a buyer is paying $200 million per year in taxes, they would pay $50 million at each quarterly estimated tax payment date. And so we've outlined a few scenarios in which a buyer might purchase $100 of tax credits. If a buyer purchases the tax credits in Q1, then they would be able to offset $25 million for each of their estimated quarterly tax payments. However, if they paid for the ITC in Q1, they would go out of pocket they'd be paying more tax in Q1 than they otherwise would have under the status quo. And that generally is something that, unless a company happens to be very flush with cash, many buyers want to avoid that. And so for that reason, we are seeing a lot of interest. In fact, a lot of buyers that require that the payments be structured more like scenario 3 or scenario 4. In scenario 3, that's an ITC example. They would commit to purchasing the ITC, say in Q1 or now in Q2, but they would want to delay the payment to the developer until Q3 or even later in the year, perhaps even Q4. And so that's one structure that a lot of buyers are insisting on. And the other is doing a quarterly in arrears payment structure. This is standard for PTCs and 45X transactions, where the buyer would commit to buying a certain number of PTCs or 45X credits, and they would pay in arrears as the credits are generated. This structure is attractive because in this case, essentially what happens is the buyer, instead of paying the IRS, call it $25 million in taxes, they would just pay the developer a 5% discount on that, call it $23.5 million at the same time or even a little bit later. So from a cash availability standpoint, they haven't gone out of pocket. And I think this is important for sellers to be aware of. If you can provide sort of flexibility on the payment terms, that will widen the pool of buyers that might be interested in your project.
Yeah, I think one thing, it may be obvious, but at this point, I wonder if there's going to be more, seasonality pricing impacts, because what you're seeing is based off of our observations and people wanting to kind of get credits later in the year, credits that are generated in Q1 are just going to be harder to monetize quickly because of this cash flow impact. Projects that are placed in service late in the year are going to be relatively in a better situation, but I think what we saw last year is the majority of projects that originally were anticipating Q4 place in service were delayed into Q1. This is something we've talked about a lot, and people in the industry are very experienced with, and that's just something that people, tax credit buyers are wary of as well. So there's a fair amount of complexity here and just some nuance to think about when you're trying to time your credit generation.
I think that's right. And one other thing I'll mention is, we get a lot of questions from buyers as well. If there's a project that will be placed in service in Q3 or in Q4, the question always is, well, what happens if that project gets delayed to the next tax year? What's my compensation or what's my recourse if that happens? And I think that's going to increasingly be a point of negotiation between buyers and sellers for projects that are not currently placed in service.
Yeah, and there's a question that just came up before we move to the next slide about is there a marketplace or is there availability for bridge loans for cash conscious developers to accommodate scenario 3? So I think the question is really, if a credit was generated in year 1, can they bridge against can they bridge the timing gap between when the credit was generated and when they actually get paid? In general, most likely, I think the lending market is generally pretty robust to the extent that the tax credit purchaser has a firm obligation to purchase, and that tax credit purchaser has credit. So we're seeing kind of variations of tax equity bridge loans being applied in very much the same context with tax credit transfer agreements.
Great question. We'll flip to negotiation. Well, let me see if there's any other questions here. I think we have one more that came up.
Is pre-selling the credits at a higher discount a possibility? In general, if you're looking to pre-sell and actually get cash in your pocket for credits that have not yet been generated, that is typically not a transaction that most tax credit purchasers are looking to do at this stage in the market. that's something I think you would need to go to the lending market for. Let's move on. I know there's some other Q&As. We'll try to hit some of those at the end here. I want to talk a little bit about, key negotiation points, and I'll try to go through this pretty efficiently. Obviously, when you're negotiating a tax credit transfer, a lot of the negotiation happens in the term sheet stage, or even before the term sheet, when you're just, hey, listen, I got interest at this price and these terms. And typically the things that the main things that people talk about initially is like, what is a discount? I don't think there's any real discussion there. What is payment? To the extent we say sharing and split of transaction costs, I would say one of the main considerations is also does a buyer require insurance or not? So those are kind of the headline negotiation points. Once you get into an actual TCTA negotiation, there's typical reps and warranties that a seller will need to make in terms of ownership, eligibility, attributes. So yes, I am eligible to claim and transfer these credits. The credits are 45, they're section 48. If it's a ITC, here's a cost basis. If it's a PTC, yes, we did a third-party sale. So a lot of the reps and warranties really track the diligence a tax credit buyer will need. Indemnification is a very important point, right? So most tax credit transfers, all tax credit transfers, basically shift the risk from the buyer to the seller. So the second bullet here says no fault indemnification is generally pretty common. And what that means is if there's any reason that the tax credit is lost, recaptured, whatever, unless it's not, a specific, if the buyer didn't specifically do it, cause that type of loss, or, was not a buyer related issue, like, oh, the buyer ran out of tax liability. In general, the seller has to provide an indemnification. And this is just typical. It makes sense because the buyer doesn't really have any involvement with the project previously. The buyer doesn't generally have any involvement with the project prospectively. They're just buying credits. They want there to be somebody to stand behind them. And typically what you see in indemnification is any loss of credits, any disallowance, recapture, but also interest, penalties, tax gross up. What that means is if there is a loss of credits for whatever reason and the seller makes an indemnity payment to the buyer, that indemnity payment is then taxable, typically taxable income. So you have to, if you have an indemnity, if a loss of a dollar, you might have to pay, $1.30 to make up for the taxes that the buyer now has to pay on the indemnity payment. And then there's an interesting interplay with insurance. The insurance product is evolving. If you do get tax credit insurance, depending on your policy, you can structure it such that the seller indemnification or the indemnification that the buyer looks for, either first seeking payment from the insurance carrier as opposed to first going to the seller. So there is a nuance there. Some sellers are using tax credit insurance as a way to kind of take their liability off their balance sheet or a contingent liability off their balance sheet. So that's something also we can walk through with different sellers. Limits of liability, either it's a formulaic amount, like, the limit of liability is a purchase price plus interest, taxes, contest call costs, gross up, or sometimes you just negotiate. It's going to be, X million dollars. So there's different flavors of how that show up. you're going to want to negotiate participation rights in an audit. Typically, a seller that is on the hook wants to be involved in an audit. They don't want the buyer simply to say, "Okay, we fold with the IRS and cause a liability there." And then there are post-closing obligations. Obviously, you have to file your tax returns, you have to file a transfer election statement, but also prevailing wage has some reporting requirements if the project is subject to PWA. And then there are some things that we help with. We want to help with document retention to the extent that there is an IRS audit. There are concepts of minimum required documentation that is required in any transfers, and also minimum due diligence, right? So there's a reasonable cause exception to avoid any credit, what's called an excess credit penalty of 20% if there is a determination of a change in credit amount.
Billy, we have one question here from the audience saying, what in your experience has been the most protracted or most contentious negotiation point in the TCTA?
Yeah, good point. I think obviously, a lot of it comes down to due diligence, right? And I think this is something that we'll talk about next. Is like, what is the level of due diligence? Is it due diligence that I prepare fairly, robust enough? Does it give enough comfort? I think all these points, when we do a transaction, we try to outline these major points up front in a term sheet so that these aren't being overly negotiated in the purchase agreement stage. So we find a lot of the negotiation is upfront before you get to the TCTA in terms of just what's a raw economic deal. And then, when you get to the TCTA point, is the insurance sufficient enough? Are there holes, et cetera?
Great. All right. Well, the last section we have here is related to ITC due diligence and PTC due diligence. So if no further questions, well, let me see if there's any questions we're getting here. Well, we have a couple questions on step-ups and step-up in the cost basis. So I think that's a great question for us to address as part of the ITC due diligence. So why don't we just go ahead and kick off ITC due diligence?
Yep.
We'll go from there.
So ITC due diligence, as I'm sure most of you know, is going to be more robust than PTC diligence. So the things that we look for in ITC due diligence is, most importantly, when was a project placed in service? Is there a cost segregation study to validate the cost basis? And then everything that might implicate either a disqualification or a recapture. So you want to understand that, yes, is this project going to operate for the next 5 years? 5 years is the recapture period. If you have a revenue contract, if you have a PPA, and you lose that PPA for whatever reason, do you still have the right to operate the project, right? So a lot of projects are in ISOs, in wholesale power markets. From a tax credit buyer standpoint, if you lose the PPA, no big deal. You can continue to operate on a merchant basis. Are there proper O&M contracts? Is there site control, right? And to the extent, like, sometimes you might ask, why do we care about site control in a tax credit purchase? Well, in year 3, if there's you lose site control and you have to remove the property, that is typically going to be a recapture scenario. Property and casualty insurance is an important one. I think we're seeing lots of news about hail, the risks of hail, and people think that's generally a P&C issue, which it is, obviously, but we're hearing that P&C insurance for certain types of events is limited. So to the extent there are gaps in your property and casualty insurance, and there's a casualty event and the developer is not able to have enough funds to restore the project or rebuild the project in a certain amount of time, then that could be a recapture event. So we always think about due diligence in the sense of what could ever happen that might create a loss of the ITCs. So step up is an interesting and evolving point. A step up is where a developer makes an affiliate, typically enters into an affiliate party transaction and claims a cost basis that is closer to FMV as opposed to the cost to build. So we're seeing FMV step ups in many contexts, especially in kind of the smaller C&I or community solar projects where the difference between cost and fair market value may be pretty high. And it's an important value driver for developers. And I think, this is probably a topic that we can spend an hour on alone. But in general, what we advise developers is to make sure that the appraisal is strong and robust and done by a qualified third party, that the structure that you are using to generate a step up has gone through appropriate legal diligence. You have maybe have a tax counsel that says, yeah, we are good with this type of structure, and then ultimately getting an insurer to cover the entire cost basis without any exclusions in the policy. From a tax credit buyer standpoint, assuming that they need insurance for this type of transaction, that's going to be very important. Let's move on. There's a lot here, but I do want to hit on PTC due diligence. Again, PTC due diligence is a lot more streamlined, right? In general, there is no recapture, which doesn't mean that your creds can never be challenged. Recapture simply means that the project, in the ITC sense, is taken out of service or is no longer energy property of the original taxpayer. That concept doesn't exist in PTCs. So you'll see wind farms that have traded, been bought and sold in their operating period. Effectively, what you want to diligence in PTCs is that electricity was generated and sold to a third party. That is the qualifying attribute of generating a PTC. Now, if you dig a little deeper, typically you'll want to know when the place in service date is, because the PTCs are good for 10 years. So we're actually working on a few PTCs transactions where we are kind of close to the end of the 10-year strip. So we have to, be very confident of the original place in service date, because we don't want to, look at credits that go beyond that 10-year date. Begun construction is actually an interesting one. I think some of you guys might remember that there were the different step downs for wind PTCs. So if your place in service date is in 2017, 2018, 2019, 2020, and I think 2021, you were originally subject to step downs. And so there was a lot of safe harboring at the end of 2016. So if a developer is claiming the full ITC amount because of a safe harbor strategy that was done in 2016 or before, then that's something that an area of pretty robust diligence. And then finally, the 80-20 analysis, there's a lot of repowers. So projects that have gone through 10 years of PTCs are now being repowered. Typically, you'll need to get an opinion from an accounting or valuation firm that looks at the costs that were incurred for the repower, looks at the fair market value, and opines to the 80-20 rule. And then I didn't mention this for the ITCs, but for both ITCs and PTCs, prevailing wage is going to be an important component of due diligence. If any projects began construction on January 29th, 2023 or later, they will be subject to using prevailing wage and apprenticeship labor, and there is a process of validating and due diligence there as well. Let me stop there. Obviously, we have bonus credits as well. Energy communities are relatively easy. The vast majority of them are location-based as opposed to brownfield-based. Domestic content, we're seeing that a little bit more, and that is going to be the most complicated bonus credit qualification. And low-income communities, typically we see that more on the solar side, but obviously that's an award letter from the IRS for starters.
Billy, one question we got here was, can you touch on the need for cost seg plus evaluation studies for ITC transfers? Are both needed and why?
So typically, if there is a step-up transaction, an appraisal is typically needed. So if you are doing some affiliate party transaction where you're saying, well, it cost me $1 to build, but my cost basis for tax purposes is now $1.30, typically a tax credit buyer and the insurer will want a valuation study, an appraisal. If you are just building a project and it's all cost, then a cost seg study is typically sufficient.
Great. And then we have another question on underwriting domestic content. What sort of products and scope of legal accounting analysis are you seeing required to obtain tax credit insurance in respect to the domestic content adder?
Yeah, great question. As I mentioned, the domestic content adder is a little more bespoke. So we have worked on a couple of transactions that do have domestic content adders. And typically what we see, the gold standard is having kind of one or both of a manufacturing kind of certificate and a tax opinion. So for example, I think it's pretty well known that DLA, a big law firm, did a opinion on the Tesla Megapack, and any Tesla Megapack deals kind of show this DLA opinion, and in general, I think the market has accepted that as sufficient evidence of domestic content. But given that the rules are still, if you read the regs, it's very complicated. So it's not something, I think this is one of the things where, involving qualified legal counsel to provide a clean opinion, while it may take some, transactional dollars to obtain, it's probably wise if you think you are going to go down the domestic content route.
Great, super helpful. I've got one question here that I'll answer, which is, are ITC bonus credits like the energy community adder seeing lower dollar per credit values than the base credit? That's a great question. Final regs for 6418 were released a couple days ago, and they confirmed that you cannot split the base and the bonus credit adders. So those would trade together as a bundle, so the pricing would not differ.
I think that maybe the question is, are projects with energy communities, do they trade at a discount to projects that just have the base card? And we don't typically see any any meaningful difference between those two types of projects.
Yeah, that's a great point.
One question here is good question. It's like, comparing traditional tax equity deals and the TCTA, how does the depth and scope of the ITC and PTC due diligence differ? Now, I think we're seeing lots of variability on the amount of due diligence. And frankly, we've been surprised in certain contexts where tax credit buyers go way, way deep. But if you normalize, well, also just in general, I think tax credit buyers, when they do their first deal, are always going to be more conservative than you originally anticipate, which is not, not surprising, right? Everyone has to do their first deal. They don't want to make a mistake. If they're doing a big deal and taking if you're doing $100 million PTC deal and making, and paying 95 cents, like they're not going to do that unless that 5 cents, that 5% discount is effectively risk-free. So in general, I do think due diligence is a little heavier in the early days than I think it will be. I think once you do your second deal as a tax credit buyer, you kind of got it, right? You understand, but the first one, you'll involve more legal, you'll probably involve, maybe an accounting firm. So it is more in depth. Now, if you compare kind of what we're seeing on the tax credit transfer and the tax equity, I've probably done, I don't know, dozens of tax equity deals over my career. There is no comparison whatsoever, right? I mean, I think that's part of what we are excited about is that there are discrete risks. There are risks to begin with. They are discrete, right? For ITCs, you need to think about recapture. You need to think about disallowance, but they are much more manageable than a tax equity deal or finance or structured financing, where basically every word of every document needs to be reviewed because you are taking both tax credit risk and cash flow risk. So I think that's a difference. So we are, we are excited about moving the market to become more efficient, but understanding the market is still early.
Yeah, I think that's right. I mean, one thing we do constantly remind buyers is that, the risk a buyer takes when they buy a tax credit is that the IRS disallows or recaptures a credit. And that's why our diligence checklist is quite focused on, areas that might, cause a disallowance or recapture. So, that's why in the ITC diligence, we do focus on, items like site control and debt structure, P&C insurance, because those are items that could potentially trigger recapture if tripped within the 5-year recapture period. But we are not, because the buyer is not making a true equity investment in the project, the specific amount of wind that blows or sun that shines is less relevant, and that's a conversation we often have with buyers to streamline the diligence process. I will mention that we have seen and we've gotten feedback as well from buyers that when buying tax credits sold out of a tax equity partnership, those can be protracted and expensive negotiations because you are not just dealing directly with one sponsor, you're dealing also with the tax equity partner. And those tend to be more complex, even though it is still a tax credit sale.
That's right. And one maybe follow-up question that just came up is, are there any technical due diligence required as tax equity usually requires? So I think what you're referring to is, do tax credit buyers want something like an IE report, which depending on the project might be 150 pages and cost $200,000. In general, no. On most credits, again, I think there's probably, if you are using equipment that's never been seen or used before, I think there might be some questions. Is this equipment going to last during the recapture period? But again, a lot of the IE reports are like, what is the production profile going to look like? And typically an ITC buyer is not taking that risk. And in general, for a PTC buyer, they are buying credits generated in arrears. So those credits have been generated in the past. Now, there's a valid question by PTC buyers, right? If they allocate, I want to buy $10 million of credits and the project massively underperforms because of a technical reason, I think there is some, validity to looking at some of the technical requirements and if it's been an operating project, looking at operating history. But typically, long way of saying that technical due diligence requirements, again, are much, much less.
Yeah, definitely agree. We did get a question previously about biogas projects post IRA. I can address that one quickly. There was some uncertainty in 2023 about what parts of a biogas project qualify for the Section 48 ITC. That was clarified and corrected by the IRS, I believe in December. And so biogas projects are eligible for Section 48 investment tax credits, and there certainly are a number of developers that are actively seeking purchasers for those credits. Biogas projects can also be used for the 45Z program as well for clean transportation fuels. Great questions here. Dennis, are there any other questions that you're getting from your side?
We do have one hand raised, and I might butcher the pronunciation, so forgive me. Beto or Beto, if you want to drop a question in the and there goes the hand. Otherwise, I think we are largely caught up on questions in the chat.
Okay, I think we have one last year actually.
Oh, yep.
Hopefully transferability has attracted more first-time credit buyers. How do you characterize them?
Well, it's my favorite question of the day.
let me take a first stab here. Well, absolutely, there's many first-time credit buyers because the pool of traditional tax equity investors, as we all know, is so small. I mean, it's dominated by a handful of large banks, but even so, the broader pool of tax equity investors is quite narrow. So there are many first-time credit buyers that have come into the market. And I would say that it's a very diverse group. We have buyers from manufacturing, healthcare, financial services, biotech, essentially any profitable company that pays US federal taxes is a potential candidate for buying these credits. And I think a lot of sort of what drives how quickly they're willing to move is a lot of the internal approval process. How forward-thinking is their tax and treasury team? Are the right stakeholders excited and bought into participating? I would say that buyers come in two flavors. One type of buyer says, I care a lot about the timing of the cash payments, and I do not want to go out of pocket at all. I want my cash availability to be neutral or better than it was prior to buying the credit. And for those buyers, they tend to favor production credits or credits where they can really delay payment. There's another type of buyer that says, I want to maximize the amount of tax savings that I can get, and I'm willing to look at ITCs and more complex transactions. And so that's another flavor of buyer. Those buyers tend to be sophisticated or familiar with energy projects. They also tend to be less sensitive to cash. Perhaps they're the type of business that generates a lot of cash, and therefore, for them, they're really looking at, over the course of the year, how can they maximize the amount of tax offset?
Yeah, and maybe one anecdotal comment is we spend a lot of time at tax conferences. And these are the conferences and gatherings that treasurers, tax directors, tax professionals go to. And I would say the awareness has meaningfully increased. Not just awareness in the sense that I think 6 months ago, everyone kind of knew that transferability was kind of here and was a big thing. I think today there's a lot of excitement to actually execute. So there is a lot of activity, and we're seeing that kind of in the number of discussions that we're having and the number of transactions we're working on. So that's all very, very positive, and we look forward to that continuing to evolve.
Great. Why don't we go over a last couple of slides here, and then if there's any last-minute questions, we'll address those in the last couple of minutes of our conversation here. I wanted to briefly go over Reunion's process. We do get a lot of questions of, hey, I have credits I want to sell. How can we start working with Reunion? And the way this typically works is we'll either have an introductory conversation or we will invite you to post your projects on the Reunion platform. There is a standard form that we have to collect information. And what goes on the digital platform is fairly high-level information that's anonymized. So, the pertinent details of your project, the size, the timing, the location, the technology type, et cetera. And where we go from there is we work to identify the right buyer. So buyers can express interest directly through our digital platform. We are also having conversations with, dozens of buyers every single week. Buyers aren't necessarily waiting by the phone for, for proposals to come their way. And so we are proactively having these conversations with buyers, many of which we've worked with before, but many that are just, considering and learning about tax credits to find the right match for your project. We will help issue a form term sheet to formally express interest in the project. Once a term sheet's signed, that typically kicks off a 45-day exclusivity process during which we will facilitate the due diligence of the project and also the negotiation of the tax credit transfer agreement. I'd say in the due diligence process, as we mentioned, buyers have varying degrees of requirements in terms of what they're looking for, but we have a good sense of generally what will fly. And a lot of this is ensuring that all of the information is collected in a format that buyers can understand and buyers can wrap their heads around. And so we will generally take the lead on sort of helping organize the data room and ensuring that all the information is provided in a format that makes sense for the buyers. With the tax credit transfer agreement, we do have a form TCTA that we bring to the table to facilitate the negotiation and really eliminate that cost of drafting and back and forth, because we've seen kind of what the main terms are that get negotiated in these types of transactions. In terms of sort of how we maximize the value of credits, we have, as I mentioned, the digital platform. We have our buyer pool that we've sort of been cultivating, and we do have a deep partnerships network as well. And so our goal really is to make sure that your projects get seen by the widest audience of buyers. The more buyers that see your project, the higher the likelihood of a great match, and the higher the likelihood that you'll have the best price that you can find. So if you have projects you want to discuss with us, please get in touch with us. You can reach us at info@reunioninfra.com or reach out to us directly.
Thanks very much. And I know there are a number of Q&A questions that came at the end, but certainly reach out to us with any thoughts. We're very eager to speak with you.
Awesome. Cool. Well, thank you, everybody. Do we have time for another couple of last questions, or should we? Let's just see here.
Maybe we'll take one, Andy.
Yeah, let's do one last one. So, this is what level of commitment from a buyer is required for construction financing debt to accept that this is coming?
Yeah, it's a hard question. In general, I think developers should assume that the lending market remains very conservative, and they will view a bridge loan very similar to a tax equity bridge loan. So in terms of that product, I assume what you're asking is, during construction, you can get a construction loan based off of project value and project cash flows. But there is a gap, another 30% or so for the that represents the tax credit or tax equity value. And typically the lenders want a commitment, a binding commitment from a creditworthy purchaser. And I would assume that's still the market. There are some banks that are doing what are called naked bridge loans. Not every bank. I would say probably a minority of banks are doing this, where they will extend maybe 60 or 65% of the tax credit value at a higher rate. if you don't have a tax credit offtake commitment. But if you do have that tax credit commitment, I think in general, the lending market will loan up to 98.5 of that value. So having a firm commitment with a creditworthy buyer is important. And we hope that the lending market will evolve to provide more capital here and take a little bit more risk. Again, I think it's not surprising that the lending markets are still pretty conservative. They're a conservative bunch, but we do expect that market to evolve. So let's cut it off there. I'm sorry we didn't get to all of your questions. Again, our email address to contact us is info@reunioninfra.com, and you can find that on the website as well. So thanks very much, and have a great day. Look forward to working with everyone.
Thank you, everybody.